Welcome back to Investing Talk podcast. Today, we're tackling a question that many of you might be asking about a company really at the cutting edge of power semiconductors, Navitas Semiconductor. Our mission here is to unpack the essential information and try to answer that key question. Is Navitas Semiconductor a good time to buy now? Before we get into it, if you find these explorations helpful for getting informed quickly, please do consider subscribing, liking, and commenting. It really helps us create more of these. And if you'd like to support us even further, there's always the option to buy us a coffee. We appreciate it. So, Navitas Semiconductor, it's a pure-play power semiconductor company, and they specialize in some, well, truly advanced tech like gallium nitride, GaN, and silicon carbide, CC. As of June 24, 2025, it's trading around $6.52. And wow, it's seen quite a bit of volatility this past year. I mean, ranging from $1.52 way up to $9.70. That's quite a swing.
It really is. And what's compelling here is the significant investor interest it's seen. A lot of that buzz comes from that recent partnership with NVIDIA for AI data center applications. But despite that excitement, the company is still facing, real profitability challenges.
Which isn't shocking, maybe, given how much they're investing.
That's a big part of it. They are pouring money into research and development. It's a strategy to stay ahead technologically, but it definitely impacts the bottom line for now.
Okay, let's unpack that, starting with the fundamentals, the core business. How has their revenue been growing? What's the story there?
Well, Navitas has shown strong revenue expansion over the last 5 years. It grew from just under $12 million in 2020 to about $83.3 million in 2024.
Okay, that sounds pretty good.
It does, although that $83.3 million in 2024 was only about 4.8% growth from 2023. So decent, but maybe not explosive year over year just then. And here's the thing, that growth trajectory has, decelerated pretty sharply more recently. Q1 2025 revenue actually declined 39.5% year over year, came in at just $14.0 million.
Wow, nearly 40% down year over year for the quarter. That is substantial. So on the flip side of revenue, what about actually making money? Profitability.
Yeah, the profitability picture, it presents some significant challenges right now. In 2024, their gross margin was 34.0%. That was actually down from 39.1% the year before.
Okay, so margins compressed a bit.
Right. But the numbers that really stand out are the operating margin,
Yeah.
negative 156.9%, and the net margin, negative 101.6%. That translated to net losses of about $84.6 million in 2024. So, no, they are not yet operating profitably, not even close, really.
And you mentioned the R&D spending driving that.
That's the primary driver. An extraordinary 91.2% of their revenue in 2024, which is around $76 million, went straight into R&D.
91%, that's aggressive.
It is. It's an aggressive bet on the future, on their technology. They're prioritizing building that competitive moat through innovation over showing profits today. It's a high-stakes strategy, pretty typical for companies trying to really define or redefine an industry. But it definitely raises that question for you, the listener. How long are you willing to wait for that R&D to pay off?
That's a great question, a bold strategy indeed. But despite those losses, we're seeing indications of a maybe surprisingly robust balance sheet. How are they managing that?
It's actually quite impressive. As of December 2024, they had $86.7 million in cash. Pretty healthy. Their current ratio, a key liquidity measure, is very strong at 5.7x. That indicates they have plenty of short-term assets to cover short-term debts.
So good short-term health.
Excellent short-term liquidity, yeah. And their debt-to-equity is minimal, just 0.02x. They're not relying heavily on debt. Plus, they had $99.1 million in working capital. That gives them a substantial cushion for operations. So while they're spending gig on R&D, they aren't, financially unstable day to day.
Right, that makes the R&D spend feel more like a calculated risk. So they're investing heavily. Where is it going exactly, and what gives them that competitive edge in such a, crowded market?
Navitas really does hold a leading position in the GaN power semiconductor market. They've shipped over 250 million GaN units. And crucially, they have relationships with all the top 10 mobile OEMs.
The big phone and laptop makers.
The biggest ones, yeah. Samsung, Dell, Lenovo, LG, Xiaomi, Amazon. Getting their tech into those major consumer devices is key. Their advantages are kind of twofold. First, a strong IP portfolio, over 300 patents issued or pending. That's a barrier. Second, technology leadership. They were first to market with several GaN innovations like 650V bidirectional GaN ICs. That's important stuff for things like fast chargers.
Okay, strong tech, good customer base. And then there's the NVIDIA partnership, announced back in May 2025. How significant is that, especially with this whole AI boom happening?
It's potentially a game changer. This collaboration is focused on developing 800V HVDC architecture specifically for AI data centers. It puts Navitas right at the forefront of this massive AI infrastructure build-out.
Because AI needs a ton of efficient power, right?
Exactly. High-efficiency power is absolutely critical for scaling AI compute. This partnership gives Navitas a direct line into that exploding demand, and, it's a huge stamp of approval from NVIDIA, one of the biggest players in the tech world. Ties right into that whole AI infrastructure investment theme.
Okay, so huge potential, big partnership. The market must be seeing this. How does it actually value Navitas right now? This is key for potential investors.
Right. Navitas currently has a market cap of about $1.25 billion.
Yeah.
And it definitely trades at, let's call them premium valuations. They reflect that growth potential we're talking about. The market itself, the GaN and C-Power semiconductor market, is projected to grow significantly from around $1.4 billion in 2024 to maybe $3.4 billion by 2029.
That's a compound annual growth rate of
About 19.1%. So nearly 20% growth expected annually for the market over the next 5 years. That's substantial. Now, when you look at Navitas's valuation ratios, like price to sales is around 15.0x. That's way above typical tech sector averages. Their enterprise value to revenue is also high, about 14.1x. Meaning the stock price is already baking in some pretty significant assumptions about future growth. The market clearly has very high expectations for Navitas to capture a big chunk of that growing market.
So the question for investors is, are those expectations justified? And is the current price worth paying for that future potential?
That's the core question. Yes. Are you comfortable with that premium today?
Got it. So high expectations priced in. How has the stock actually behaved? You mentioned volatility earlier.
Oh, it's been an absolute roller coaster. Extreme volatility. We're talking an annualized volatility of 126%.
126%. That's wild.
It is. Think massive price swings. Over the last 12 months, it's actually down about 38.7% from where it was. Currently, it's $6.52. But following that NVIDIA partnership announcement in May 2025, the stock surged over 160%.
Huge jump on the news.
Massive jump. Technically speaking, that previous low, around $1.52 back in April 2025, looks like pretty strong support. And the 52-week high of $9.17 is the key resistance level to watch overhead. Right now, the technical picture is a bit mixed, but the recent price action suggests maybe a recovery from being oversold. But yeah, definitely a stock for those who can stomach big moves.
That kind of ride isn't for everyone. What about the analysts? How are they viewing the company? And importantly, any notable insider activity? Are the people running the company buying or selling?
Analyst sentiment is, I'd say, cautiously optimistic. The consensus rating is a moderate buy based on 6 analysts covering it.
Moderate buy, so not a full-throated endorsement, but positive leaning.
Pretty much. Their price targets are all over the map, though, from $1.50 on the low end up to $7. The average target is $4.31. One interesting note, Deutsche Bank recently downgraded to hold, but they actually raised their price target to $7. So a mixed signal there, too.
Okay. And the insiders.
This is where it gets maybe a bit concerning for some. There's been quite a bit of recent insider selling. The CEO, Gene Sheridan, sold about 2.16 million shares in May 2025. Multiple directors like Brian Long and David Moxham also made significant sales. Another insider, Ranbir Singh, sold over 2 million shares too, although to be fair, he still holds a substantial amount.
That's interesting timing. Right after the NVIDIA news sent the stock soaring, why would insiders be selling significant chunks if the future looks so bright?
That's the million-dollar, well, maybe the billion-dollar question here. The research doesn't give a definitive answer. It could simply be opportunistic profit-taking after a huge run-up. Perfectly normal.
Taking some chips off the table?
Could be. But the sheer volume across multiple insiders does make you wonder. Are they seeing a longer road to profitability? Maybe a slower ramp-up with NVIDIA than the market expects. It adds a layer of uncertainty, for sure.
Definitely something to keep in mind. Okay, looking ahead then. What are the key things, the catalysts, that can move the needle for Navitas going forward?
Short term, say the next 3 to 12 months, all eyes will be on the Q2 2025 earnings report, probably early August. We'll want updates on that NVIDIA partnership progress. Also, watch for news on the ramp-up of their 12-kilowatt power supply platform for AI data centers, and maybe some new customer announcements following the Computex Tech Show back in May.
And longer term, say 1 to 3 years out.
Longer term, the big one is the actual deployment of that NVIDIA 800V architecture. That's expected to really start materializing revenue-wise in late 2026. Big potential there. Beyond NVIDIA, there's the whole electric vehicle charging infrastructure market adopting GaN and Thicket. That's huge. Plus just the increasing demand for super efficient power as AI keeps growing. And the overall GaN market itself is projected to hit, nearly $12.5 billion by 2030, growing at like 27% a year. Those are major tailwinds.
So massive potential, clear tailwinds, key partnerships. But every investment has risks. What are the big ones investors absolutely need to be aware of here? What could go wrong?
There are several key risks outlined. Company-specific first. That unclear path to profitability. How long can they sustain the losses driven by that intense R&D spend? That's number one. Also, their heavy dependence on the mobile device market and those key OEM relationships. If one of those big customers walks, it hurts. Manufacturing dependencies, too. They rely heavily on TSMC for GaN production. There aren't many alternatives, which creates a potential bottleneck or single point of failure.
And competition.
In competition, yes. Increasing pressure from established giants like Infineon, who have much deeper pockets and existing market reach. Then there are sector risks. Semiconductors are cyclical, right? They swing with the economy.
Oh, we have, yeah.
Plus, rapid tech changes. What if something better than Jane or Systemedio comes along quickly? Obsolescence is always a risk. And, of course, supply chain issues or tariffs could always pop up. Finally, market risks. We talked about the valuation concerns. Those high multiples mean there's less room for error. There's liquidity risk, too, given the high volatility and relatively small market cap. And maybe most importantly, execution risk. Can they actually deliver on the promise of the NVIDIA partnership? Can they scale production effectively? That's critical. These are the headwinds you need to weigh.
Okay, that's a comprehensive look at the risks. So putting it all together, the potential, the challenges, the valuation, the risks, what's the overall takeaway? What kind of investment profile does Navitas fit?
The overall assessment seems to be around a 6 out of 10. It really positions Navitas as a high-risk, high-reward play in this emerging GaN-6 space. The NVIDIA partnership offers very significant long-term upside, no doubt about that. But the near-term profitability struggles and that premium valuation creates substantial risk right now.
So who is it best suited for?
It seems better suited for long-term investors. People who have maybe a multi-year time horizon, who understand the development cycles for new tech adoption, and who anticipate those NVIDIA benefits really kicking in more around 2026, 2027. It absolutely requires patient capital because of the current lack of profits. For short-term traders, extreme caution is advised. That 126% annualized volatility and the way it swings wildly on news makes it very tricky.
Any thoughts on entry points or managing risk?
The guidance suggests a few possibilities. A more conservative entry might be down in the $4.50 to $5.50 range. An aggressive entry could be right around current levels, near $6.50 if you're really bullish on that AI infrastructure theme playing out quickly. A value entry, if you could call it that, might be way down in the $3 to $4 range, perhaps if there's a broader market pullback that creates an opportunity. And for trading, definitely consider a stop loss, maybe around $5.50 to limit potential downside. A take-profit target could be aimed towards that $8.59 resistance area. And given the volatility, keeping position size small, like 2–3% of a portfolio, seems prudent.
Okay, so wrapping it up, what does this all mean for you, the listener, considering Navitas Semiconductor?
Look, Navitas gives you really compelling exposure to this fast-growing power semiconductor market. They have differentiated GaN and Psychotech, and that NVIDIA partnership is a major potential catalyst. However, you've got this combination of a high valuation, the current lack of profits, and that intense volatility. It really makes it most suitable for risk-tolerant investors with a long-term view who truly buy into the AI infrastructure narrative. It demands careful position sizing and, probably most importantly, patience. You need patience for that technology adoption cycle to play out and mature.
And maybe as a final thought for everyone listening, as you explore this space, think about just how quickly these new technologies like GaN and SiC can reshape entire industries. And what does that rapid pace really mean for patient capital in the semiconductor world? And maybe even what innovations might be coming next that could disrupt even these technologies down the road. Something to ponder. Thank you for joining us for this deep dive. We hope you found it insightful and useful for your own learning journey. We'll be back soon with another exploration into a new topic.